Hello and welcome to this edition of All About Your Company. Here is a tech stock which is trading at maybe late teens in terms of price to earnings multiple and is promising a 30% growth CAGR at least over the next few years in the medium term. Now they've come out with numbers, of course, and really essentially are those numbers as important? Maybe not. We'll try and understand the broader picture on what's happening with an Aurionpro Solutions. The first thing I want to know is why is there a drag with regard to cash flow? Now, this is a typical service provider in the tech space, not core IT solutions, and we'll discuss the product lines a bit and you'll get a sense. Banking, financial services is what they specialize in, but outside of that, they also have a specialization in the tech stack of the Mumbai Metro, for example, where ticketing, cards, and the like can be used in the Mumbai Metro and the entire tech that goes along with it. And that's why it's an interesting piece. Why is the cash flow a drag versus EBITDA? That's the first thing I want to know. The second one is order book visibility and growth. Now, the order book itself, we will discuss that number, has been growing 100%. For sure, it's been growing, not by 100%. But growth of that, what is by the looks of it, where does it keep going? Because what they seem to be suggesting on con calls is that there is plenty of traction, but they're not making the most of all the traction that's coming in because capacities aren't fully built up for that. So we'll try and understand both of those. More importantly, annual recurring revenue, because you've got an order book size of 1,500 crore, of which 80% will be executed in the next 12 to 15 months, but annual recurring revenue on top of that should add to the top line. So we'll try and get a sense as to how that is moving. Growth across verticals. Now they have three verticals broadly: banking, fintech, then there is a tech innovation group, and then there is cybersecurity now. So cybersecurity, cloud, and the like. But mainly it is banking and financials or fintech and innovation group at this point. So I'll break the products up, give you an explanation. But more importantly, where does growth go for each of these verticals and how does cybersecurity add to top line going forward? Now, the fifth piece and the most important piece, the risk of AI in a business like this, because we've seen across the board IT in a sell-off mode because of the risk of AI coming to the fore. Could this company in particular be actually an opportunity rather than a risk? And is AI a big risk for it or not? We'll try and understand how that plays out. And what are you investing in terms of free cash flow? So it will start generating very strong cash flows going forward, if at all that EBITDA conversion were to happen. And therefore, what is the deployment strategy with regard to cash? So we'll understand all of this. Now let's talk about the company. Let's give you a quick snapshot. It's an IP-led software and platform company and therefore invests quite a bit in R&D as well. There's some intangibles in the balance sheet. In fact, 30% of its balance sheet is intangibles. That's the other thing I want to ask the company as well. There are two segments currently. One is banking and fintech, and second is the tech innovation group. And we'll split the products and quickly give you a snapshot of that. It's present in 14 countries, currently has 350 plus clients at this point, but it's diversifying fast, both on the client front as well as on the country front. And there are plenty of opportunities which are popping up. In fact, over the last 3 to 4 months, they've had a slew of order wins. H1 was the best client addition that they ever had in their history. 35 new clients or logos added, as one would call it. Now let's talk about the products. In terms of the product segments, the first segment is banking and fintech. Now, the products will come up on your screen. iCash Pro, it helps big companies send, receive, and manage money easily. Oro Digital lets companies use banking and phone, computer or tablet. There's Integro or Smart Lender, which helps banks decide whether to give loans, track repayments, and the like. Then there's OmniFin, which is a software for banks to give loans to people and small businesses. There's FinTrade, which helps banks manage import-export paperwork faster. There's Orion AI, which is a smart brain that helps banks make safer decisions and explain them in terms of the decisions that they make. There's Oro Pay, which lets business collect digital payments legally under the RBI rules. There is Interact DX, which helps banks send the right messages to customers the alerts, the SMS alerts, etc., email alerts that you get, and the app alerts as well. Then there's Tech Innovation Group. This Tech Innovation Group largely focuses on transit and mobility solutions. And so software, machines for ticketing, gates, traffic systems. There's also an open loop transit payments which they do, which is through cash, through debit cards or credit cards, and for traveling on buses and metros. There's smart city and smart city systems, which is a tech for city control rooms, cameras, and public safety. There's data center and design and management, which helps companies build and run large computer server systems in their buildings. There's hybrid cloud services, which helps move data between their own servers and the cloud. And then there's kiosks, micro ATMs, etc., and devices, which also is something that they work with banks on, which is machines for self-banking, card issuing, and cash access. Now let's talk about the geography. Now you've got a decent snapshot of the products. In terms of geography, 66% India, 19% is other Asian countries, and they're penetrating very quickly into even the Middle East, for example. Then there's US and Europe, which is a large opportunity, but it's still just about 13%, and then there's others of around 2%. So that's broadly the split. Now, in terms of customers or wins, just to illustrate to you the cohort of customers they work with, MMRDA for the purpose of their Mumbai Metro, SBI, for example, is a customer. Along with SBI, there's UCO Bank and other domestic banks which have been added of late because as they try to ramp up on technology, some of these banks require Aurionpro Solutions to try and scale up on their banking. And then there's pacts with Visa and MasterCard globally, where they get referrals for customers globally all across the world to try and source new customers. Now let's talk about the numbers, and this is where it gets really fascinating. In terms of the 3-year revenue growth, it's been 32% CAGR in terms of top line growth. We've seen it climb from 505 crore to 1173 crore at this point. We'll try and project the growth out on a 30% growth basis in a few minutes from now. Let's also look at EBITDA now. It's gone from, again, the EBITDA also has gone up 30% CAGR, so margins have largely remained very, very steady. Profit has gone up 35% CAGR. So this is a company which is growing at 30% plus on a consistent basis over the last years is what we see. In terms of the 9-month FY26 numbers versus the FY25, you've seen 26% revenue growth and 22% EBITDA growth. PAT growth has lagged. That's broadly the current state. When you're looking at the operational metrics, you look at how the order book has shaped up. It's gone from 1,000 crore to around 1,500 crore currently. This is trailing 12-month numbers. You look at the revenue, trailing 12 months is around 1,390 crore. And therefore, you're looking at a book-to-bill potential of around 1.1 times. 80% of this gets executed in the next 12 to 15 months. And then this excludes annual recurring revenue that the company earns. And this, the management has clarified a couple of times in the last few quarters, that this does not include your annual recurring revenue. You look at margin trajectory now, it's been in the 20 to 22% band, and that is what the management continues to guide for. It's come off because they continue to make investments where in newer geographies is what they're doing, and that's why you're seeing a bit of a inch down in terms of margins, but you're seeing a 20 to 22% guided band in which they expect margins to operate. You look at cash flow, and this is where a possible concern could arise. You're not seeing conversion of cash flow or EBITDA to cash flow, and that is the one key metric which I'd want to understand from the management exactly what's happening here. So that's one concern. 85% in FY24, 65% in FY25. Payments do come with a lag, but how much of a lag and how do they plan to improve it if they do? The guidance is they want to get this to 80%. So that's the guidance. We'll try and understand that better. Let's talk about return ratios now. You look at the ROCE numbers. They've done very well for themselves. It's regularly clocked 18 to 22% ROCE. Of course, FY21 was an aberration. But outside of that, it's done very well for itself overall in terms of ROCE. You look at shareholding pattern. You've got promoter holding of around 27%. They've been diluting their promoter holding through QIPs, which is through fresh issuances. And there has been plenty of interest at higher levels in terms of the issue price. They have done a QIP at 2,000 odd. They've done a QIP at 1,800, 1,500 odd. So there have been a couple of QIPs over the last 2 to 3 years which have come through, which is why you've seen a dilution in promoter holding from 33%, in fact, to 27%. FIIs have increased their holdings, and there are some interesting FIIs in that mix. DIIs too, largely stable, and then of course the balance is held by the public. Now let's look at valuations, and this is where it starts to get really interesting because we've tried to map the numbers going forward. There are 4 brokerages which track it, but we've disregarded that. In terms of valuations, you've seen FY26 to be at around 2,500 in terms of top line, 1,500 crore in terms of top line. FY28, it'll be roughly 2,500 crore. And the PAT margin that they've guided for is approximately 15% or so. And therefore, the PE, if I push it to FY28, given the visibility we have, is around 13 times. If that were to play out, of course, viewers, that is a caveat that one needs to look out for. The 5-year average PE is 24 times. The 5-year PE range is 5 to 53 times. So you've got a very, very wide range, but it's well below the 5-year average price to earnings multiple that this one trades at. The guidance is 30% growth, 20 to 22% margin, 80% EBITDA to cash flow conversion. And of course, we will speak with Ashish Rai, who's going to be joining us. He's the Group CEO of Aurionpro Solutions in just a minute on the other side of this break. Ashish will come straight to you. Right, that snapshot. Let's quickly bring that up with regard to what we've discussed with regard to Aurionpro Solutions. Also, let's bring up a snapshot of the valuation, which didn't really come up on your screen. So yes, there's all of these, plus there's valuation, which will quickly come up on your screen. There you go. That's how the revenues will likely get mapped if there's a 30% growth, and there's around 14 to 15% or 15 to 16% kind of net profit margin. If this were to play out. The price to earnings ratio, there you go. It's on your screen now. And the market cap, of course, has fallen from 5,300 to 5,000 this morning. There's also one more quick change. You have a look at the 5-year valuation and you'll get a picture of how the price to earnings has evolved over the last 5 years odd. And you can compare that with this snapshot that you're getting. We'll put this up, of course, but Ashish Rai, let me bring him on board. Ashish, let me start off by understanding from you, how should one look at cash flow conversion for you? Explain to us why that cash flow doesn't come through. Explain the business model and give us a pulse of what's playing out.
Hey, Harsh. Hi. First of all, thank you for having me start with the cash flow question. Look, I think...
Great having you, Ashish.
Yeah, so great to talk to you. So look, I think cash flow... Look, I think the way to think about it is the following, right? I think our cash flow conversion generally has been fairly strong the last couple of years, but it tends to go through a little bit of a cyclicality, right? I mean, I think one is most of our business is delivering products and implementing them, and typically the payment cycles get skewed towards when you actually take the client live, right? So, so as you go through the year, by the time you get to Q4, typically net of tax, we are able to convert anywhere between 60 to 80% of EBITDA to cash. But in between the year, there'll always be a little bit of cash stress, right? But I think generally speaking, we've done a pretty solid job of being able to convert that EBITDA to cash the last few years, and we'll continue to do that. I would say the other way to think about it is, so we used to be, if you go back, I can see you showed numbers till FY22. You go back FY21, we were 375 crores, right? This year, you're in the range of 1,500 crores. So you basically quadrupled the business over 5 years, right? It's very, very difficult to have, a mature company style cash flow conversion and a startup style growth at the same time, right? Because when you're growing at 35%, what is really happening is you are really investing at breakneck speed. You're like shipping products out at breakneck speed. You are expanding into new markets. So there'll always be a little bit of delivery stretch. There'll always be a little bit of lead time in terms of conversion, especially given the product business, right? So I think that is the other way I would think about it. I would say it's very unlikely that a very fast growth business gets to, let's say, 80%, 90% EBITDA to cash consistently or even more. But as the growth rates, when you mature, so right now we have no plans to slow down, but let's say you had a plan to slow down to a more 10, 15% sort of growth rate, you'll improve on the cash conversion, right? But that's not on the cards for the next few years. We want to expand, we want to grow, we want to build out the strongest possible technology brand that can operate globally, right? And that's what the focus is.
Sure, Ashish. Ashish, you've got 1,500 crore of order book, which you will likely deliver over the next 12 months, 80% of which you will likely deliver over the next 12 months. Talk to us about how much are you currently doing in terms of annual recurring revenue?
So the way we look at it, Harsh, because it's a little bit of a diversified business, so different depending on the business you're talking about, the stream sort of varies. I would say right now about 56 to 57% of our revenues come from what we say recurring or near recurring kind of sources. So which is basically your AMCs, your subscription payments, ongoing services around the product, and revenue share and things like that, right? And I think that is more or less where it would stay.
Order book visibility, you'll continue to grow it at maybe a 20 to 30% clip. Is that something which you will consciously do?
Yeah, so look, you can always from one quarter to the other, things may vary, but typically the way it's panning out right now. So I think you mentioned the 1,500 crore number. I think that was probably a quarter dated. So we'll publish the new number now, which is slightly more than that. But typically the way that's happening is in a most right now, let's say you're clocking about 350, 370 crores of revenue in a quarter. That gets reduced from the order book, and you add, let's say, 400, 420, 430 crores of new orders in the quarter. So net, you go up anywhere between 20 to 50 crores in a quarter. In a good quarter, it may even go up to 100 crores, right? So that's how it's sort of been behaving. We keep on expanding the sales channel. So our sales channel is now significantly larger than it was, let's say, 12 months back. We are now in Europe with a very strong channel. We were not there 12 months back. We are expanding into the US. Middle East and Africa has been a fantastic expansion for us over the last 12 months, 18 months, right? So we will continue to grow the channel and hopefully keep growing the order book at the same level. The second thing that's happening that's important to note is the product portfolio has been expanding, right? So while it looks like you're in the same areas, which is banking, software, transit, etc., the portfolio itself is getting much wider. So that also improves the ability to keep adding to the order book, right? So I feel good about how we are adding it, and I think more or less we'll stay on the same clip.
Correct. Ashish, margins have come down marginally, right, to around that 20% kind of number. You believe they'll bottom at 20 and you will focus on growth with a 20% margin, and thereafter, as efficiency starts to play out, it'll start to inch higher, or will it sink below 20 in any quarter?
So no, it can sink below 20 in any quarter. So I think, look, basically the way to think about margins is this. Over a long run, if we are able to build out a mature product-led business, like 35, 40, 45% EBITDAs are fairly normal in the business at scale when you slow the growth rates down, right? You would not get anywhere close to it in the current growth phase of the business, right? So the way we are managing it is we try to keep EBITDAs near that number, which is a 20-odd% number. And as the economics is improving, the core sort of operating leverage keeps coming on the software products, especially on transit side as well. We keep pouring the excess into R&D. So the same R&D budget, which was like 40 odd crores probably 3 years back, is 120 crores plus this year. And that will keep on growing because we keep on building more and more products. So the goal is keep pouring the excess back into R&D, keep EBITDA more or less around the same level. But I think the opportunity zone that we are going in, we've never seen, I don't think any of us have seen an opportunity so large in our lives. So we may want to step up the R&D expense. We may want to do that. So one quarter to the other, things may vary, right? So I would not set the expectation that margins would never dip, because it's not so much a function of economics of the business. It's a function of economics as well as how much you want to build in the product,
Sure.
right? So, yeah.
Sure. Ashish, a lot of the R&D spends for a lot of IT companies, and I know you're not a core IT company and therefore not a comparable, they like to expense it out. You don't. You seem to be capitalizing it. And now a large part of that is sitting on your balance sheet. You want to kind of explain that, and also what do you do with the cash flow that comes in? Because now you'll start having larger and larger cash flow pools as well, which is building up within Aurionpro, which will be far larger than the 150 crore kind of number which you've used for R&D. What do you do then? You start distributing dividend?
Okay, so I'll come to the second part of the question a bit later. Maybe you'll ask you to repeat that. But let's go to the capitalization part, right? So for most of the core, not most, all of the core products that we have, we don't really capitalize, right? So you look at transaction banking software, lending software, so the P&Ls which can support themselves, we don't really capitalize. So I would sort of contest that point a bit. The only small way in which we've capitalized is where we've gone after some regulated businesses, we, like payments, etc., where we wanted to really build out some core IP and also go through some regulatory licenses and all that stuff. So we wanted a strong sort of evidence behind it, right? But that is actually, compared to the scale of the business and the scale of the balance sheet, that is a very small number. Bulk
Sure.
of the intangibles that you see on the balance sheet are actually not capitalization of software build outs. That's actually coming from goodwill. Right?
Got it.
And which is where we've been reasonably prolific in terms of acquisitions that we've done over the last 6 years.
Right.
And unfortunately, the way the accounting system works, it's been so most of the accounting system has not been designed for software, right? So when you buy a software business,
Yeah.
you're buying an intangible asset, and you have to put that value on the balance sheet as goodwill, right? So I think that's
Right.
what most of it is.
And free cash you distribute likely at some point?
I mean, when we are many times our current size and let's say the growth rate has slowed down to 10, 15% like all mature companies, why not, right? But I think right now the
Sure.
universe is so large. So I think, Harsh, the important thing
Sure.
to think about is what are you building, right? If
Right.
your goal is to
Absolutely.
build out the most impactful technology organization that India has ever seen, right, that can really go and make impact on the globe. I mean, do you really want to start distributing dividends, right? So I think, yes, we do a little bit of dividends here and there, but I think the goal right now is to build as significant a business as we can build. And when we become really large, many times the size growing at 8, 10%, like a lot of other firms do, yeah, you got a lot of free cash to distribute. Why not?
Right. Ashish, thank you so much. This has been great having this conversation and getting that perspective. We'll let you go on that note. Viewers, plenty of food for thought. We'll end it here. Thank you so much for watching.